When it comes to investing, retirement, taxes, healthcare, and estate planning, the decisions you make today can greatly affect the quality of life for you and your loved ones tomorrow. What you need is straight and unbiased information on the most important issues you'll face when planning for your retirement and financial future. Good news, you found Premier Retirement Radio with Jeff Hogan. Jeff is the founder of Premier Retirement Planning and Wealth Management, and he's been guiding people financially and into retirement for 30 years. So get ready for an hour of the most comprehensive financial information on the radio. Premier Retirement with Jeff Hogan. And now here's Jeff Hogan and Jeff Shea.
Thank you so much. Welcome to Premier Retirement with Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. My name's Jeff Shea, and as always, I am just here to ask the questions for you. But the words of wisdom and solid advice, they come from Jeff Hogan, founder and president of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Hey, Jeff, welcome back. How are you this weekend?
I'm doing great. How are you doing?
I'm doing great, thank you. Glad to have you back. You were elk hunting, I understand, just last week. How well did you do?
Oh, well, just being out in the mountains, you always do well. Just to be out there, it's interesting. I monitor my blood pressure, just not that I have a tense or intense life or a stressful job or anything, but just for health reasons. And it's interesting. I check it at least daily.
Yeah.
And it goes down like 10 to 15 on both readings, diastolic and systolic both. So when I'm up in the mountains, life is just good. So,
wow.
It just, it's nice. So for no other reason, hunting's always a success. Saw a lot of elk. It was early. The moon was full at night, which means they don't move around much during the day. They did show up somewhere between half a mile and a mile away if I glassed them up, but only had a couple of chances where I got close. I hunt with a bow, so you got to, see an elk is one thing, closing the distance and getting a shot is another. And, odds on elk hunting with a bow are about 10% success rate if you're going to talk about getting meat home.
Yeah.
But I'm about 40%, so it's not that bad overall, but I shot one last year. I didn't shoot one this year. Just the way the luck of the draw goes sometimes. I am going back out. The reason I hunted a little earlier this year in Utah, which is one of my favorite spots to go, is because I did draw a tag for bull in Colorado, which starts in September. And typically I like to start hunting in September. That's when the rut gets going, when the elk start moving around, getting noisy. They start talking and making noise, so you can find them a little easier and stock in on them. But if they're quiet and they're doing all their movement at night, it creates a hard hunt. So I had probably one of the hardest hunts as far as just my odds of success were pretty limited. A couple of my friends came up and ended up, one of my hunting buddies is a heart transplant patient, and he's gone 10 years now, but he has a valve that's been kind of fluttering on him, and it was giving him some trouble after just one day, so he went home. He's still able to carry a little bit of meat out if I needed a little help, and I could certainly help him. He had another one of our hunting buddies with him that was riding along, so they had to go early. So I was on my own for most of the week, which means my treks into the wild are a little bit limited, given the fact that if you do shoot something in there, you have to get it out. So kind of limited things a bit, but next week I'm going to go out again to Colorado, and
really?
I was there last year, so kind of know that area. It's a little closer to the September time frame that they start moving around. The moon's going to be better. So I expect to have a little bit more luck. I wasn't really too stressed out about last week's hunt because I knew I had Colorado coming up, and I've got a group there that even has some horses to help me pack it out. So if I want to go 5 or 6 miles off the trail, I can go and find what I'm looking for and not worry about how I'm getting out of there.
Well, you got to be
dying
good.
Of a heart attack at 12,000 feet.
Yeah, I was going to say
300 pounds of meat out of the mountains. So.
You got to be good to hunt with a bow, and people, I think they think of the cowboys and Indians, but it's a whole different thing, bow hunting these days. Very, very sophisticated. But anyway, we could talk about hunting and bow hunting for the rest of the show here, but it'd be a totally disappointing show for the audience. So let's talk about financial planning. Let's talk about what's going on with money today. And inflation certainly is on the minds of people. We've talked about interest rate cuts, but I want to talk a little bit about inflation here and whether or not a president can really fix inflation. I don't think that a president really has that much influence over inflation, or Jimmy Carter and Gerald Ford would have not been one-term presidents. But what do you think today as opposed to when they were presidents? Can the president affect inflation?
They certainly can. In fact, we can see that the policies in the White House have kept inflation under control, and the policies in the White House have created inflation. Jimmy Carter's policies were horrible, created inflation, not even just inflation, but stagflation, which is even worse, where you have negative job growth, negative GDP growth, and prices still going up. So it's like typically when you start having the recessionary pressures of lower unemployment, less demand because people can't spend money on things. It typically creates kind of a deflationary period, or at least gets inflation under control. And it doesn't during stagflation. That's really where we are now. Nobody will admit it, but we're kind of in a stagflation state. We got past the inflation and we're stagflation because, we even know that, just recently we had the jobs numbers over 800,000. It's 833,000, I think the number was, 833,000 jobs that they misrepresented over the past year. The government said, we created these jobs. Well, the government doesn't really create jobs, but their policies can make a situation where jobs are easier to be offered by businesses if the business climate is being supported by lower taxes, being supported by, cheaper costs of food, energy, and things like that. I think the biggest thing that got us into the mess that we're in, obviously, is all the money printing that's been happening since Obama. So basically, we were just priming the pump for future inflation. And as soon as there was a supply chain hiccup because of the pandemic, the dragon reared its ugly head and it kind of blew up on us like, oh, gee whiz, the consequences of our actions finally caught up to us. And that is we printed money. That is too much money. The people that have the money have no problems buying the things that, are out of supply or overpaying for things that, they can overpay for because they can afford it. But then the middle class people that weren't heavily invested in the stock market or didn't have the extra money because they were just making ends meet, raising families, or just working paycheck to paycheck and so forth, don't have the ability to have that extra income, the discretionary income. So they're suffering. And, things from especially the middle class on down, those people are struggling and they're not buying stuff. And it isn't creating, the GDP growth that we should. The GDP growth that we're getting reported is basically the White House saying, we created a bunch of government jobs and we handed a whole bunch of money out and government spending, and we call that GDP, gross domestic product growth, and it's not accurate. The other thing is they would always, puff up the numbers and say, we created these jobs. The president doesn't go out and put ads out for job growth. They don't go say, hey, we're going to hire this many people in X. All they can do is they can hire government jobs, and about 60% of a lot of that job creation, so to speak, was in fact government jobs, and the rest of them were really netting out more layoffs and more retirees and more unemployed than the jobs that they were actually creating. So the numbers have been faked. I've been saying this for a long time. I mean, this is probably one of the most transparently blatant lying White Houses we've ever had. I mean, I hate to say it, but I mean, it's blatant. But for whatever reason, if the news reports it differently and the news is kind of in their pocket or they're in each other's pockets, then it's not really a big deal, or it's not a bad thing, or it's not real. Well, it is real. The fact is that they're overinflating the numbers. As soon as Biden got into the White House, he, with a stroke of a pen, undid everything that President Trump did from the standpoint of especially our energy independence. That was the biggest deal. Energy independence went out the door. Energy affects everything. The cost of fuel, the cost of transporting the fuel, the cost of importing, oil at, $75 or $80 a barrel instead of, producing it here at $40 or $50 a barrel and keeping the price down around 50 or 60 when you could buy gas and diesel for $2 a gallon instead of, somewhere around $4 like today. Well, if the price of groceries, 30% of the price of groceries is attributed to just the cost of transportation and getting it to the stores, and the price of that cost of just the fuel alone doubles, and then they have to raise, let's say wages and other things because everything else goes up along with it. It may not become now 60%, but it could raise, let's say it could raise food just in that case alone 20 or 30%, which is what we've seen. So, they're saying, companies are price gouging. These companies are, 4 companies own all the food and outlets and they're just price gouging. Well, they're not. The net margins are like, I think, below 2% on the typical grocery. It's a volume business. They're not price gouging. Yeah, okay, when you're dealing billions and billions of dollars worth of groceries, yeah, there's millions and millions of dollars worth of profits. But, there's investors that need to get dividends and pays and growth on their stock. There's executives and employees and workers that need to get paid. So it isn't a price gouging situation like they're claiming it is. They're blaming corporate America for screwing us over when it isn't. It's the government policies that went into place in the first place. Now, could government fix inflation? Well, it takes a while to undo the damage that they've been doing for the last almost 15 years or so since Obama said, hey, you know what, let's go modern monetary theory. That is where we just print money and make the market look good so everybody thinks that the economy's good. If the market's good, then the economy must be good and nothing else really matters because everybody with money and everybody with investments are the ones that get us elected anyway. So let's just continue to feed the hand that feeds us, right? So they kind of work together. So again, I think it's obviously that economic policy, and unfortunately so many politicians don't understand economics enough. They just understand, how to win elections, and that is by, telling everybody what they want to hear, not what they're really going to do, and somehow suckering them into voting for them. And then when they get into power, what do? They just make policies that change the world, and they have no idea what the ramifications of those policy changes are. Or if they do, they're either puppets on strings, which I think a lot of politicians are. They're being bought by, the cabal, the people that are running the world, the super powerful, the Bill Gateses and the George Soroses of the world. And, most of them are, basically power mongers that, want to rule and run everything. And it's all about power and control. And the government is their puppets. And as long as they pay them to get elected and rig the system to where they can get their puppets in place, then they can make policy that affects the rich to get richer and the poor to get poorer. And unfortunately, that's what inflation is. Inflation makes rich richer. Inflation typically is when there's, you charge more for your goods. People that own businesses, inflation, if they own a lot of real estate, inflation makes their real estate go up, so their portfolios go up. That gives them better buying power, better borrowing power. They can start more businesses. So the rich get richer during inflation. Politicians do better with inflation. I mean, from a personal standpoint, they may not do it if, enough people say, hey, this is enough already. We're not going to vote you back in. But then they give some stories like, oh, but when we get elected, we'll fix it. Well, wait a minute. How can you fix it? You got to undo everything you just did. How is it that, Bidenomics is the best thing ever and it's working, but now when I get elected president, I'm going to fix it? Well, what do you have to fix if Bidenomics is working? Well, it isn't working. It's not working. And it's the policies of the new administration that disrupted the policies that were working, where inflation was around 2% or less, even during the pandemic. Now, we did get a little bit of inflationary pressure because of the supply chain breakdown, and it was also not just due to, we have to admit, just during the Trump presidency, there was a lot of other stimulus created during the pandemic in order to keep the world alive, keep the world moving, and keep the economy buzzing along, at least at a subsistence level. And that didn't help the problem any. It did kind of exacerbate the situation. But, as long as we've got the supply chain moving and we don't have ships backed up for 6 weeks off the port of Long Beach, in California, like we did as soon as the Biden administration put restrictions on imports and all the different rigmarole that they put on things, and actually created a supply chain shortage much worse than it ever was created under Trump. And I'm not necessarily, I'm not comparing politics here. I mean, I think most of our listeners kind of lean the same way I do. But the fact is, while there was still some problems and some things that happened with this pandemic that made it really hard for Trump and made inflationary pressures a real deal, they got exacerbated and just compounded exponentially as soon as Biden, who knows nothing about business and economics, got in and with a stroke of a pen wiped out all the policies that were at least keeping things afloat and gave us a chance to get out of this recessionary position during the pandemic, not necessarily unscathed, but with little problem. But when you aren't energy independent, that's a big deal that drives inflation. When you keep on stimulating the economy by giving banks bailouts because they can't collect their own loans, or they have a high default rate and they don't want the banks to break down, so they just start handing them money and the banks just start buying their own stock. It creates an illusion of a great economy just because the market's going up, but it only affects the rich, the Wall Street people. But guess what the rich and the Wall Street people have been doing? They've been using this rally to sell. They've been selling and depleting their cash stores. Shoot, I tried to short stock a couple weeks ago when the stock market fell. 4 different times I was told Charles Schwab did not have any stock to loan me to short. Are you kidding me? They're the market makers. They had all the inventory, yet they're selling so much of their own stock, they don't have enough so I can sell it. Yeah, I thought that was kind of interesting, and I'm not the only one that has this story. I was reading different commentators, market commentators and watchers, and it's interesting just how manipulated we're being by the news that's out there on how great the economy is just because the market's going up, but it's being manipulated. The jobs are not there. The yield curve is inverted still. It's getting uninverted, very close to uninverting. And, we have inflation that's finally starting to ease a little bit because it can only grow so much on top of the 25 or 30 that we've already had. The inflation rate is still growing at 2 or 3% on top of that. And now they're coming up with these new annualized, okay, so the last 3 months inflation rate, if you annualize it on a regular on a basis, it's somewhere between 2 and 2.5%. Well, that sounds great. Well, let's just go back a year and see what it really is. It's 3.5 or 4. So are we really getting inflation from a year ago under control? Well, I guess the current growth rate is okay. And if it can maintain right where it is right now for another year, maybe we'll be down closer to that 2%. However, as soon as you start lowering interest rates, what do? Lowering interest rates is like a creation of money. It's like printing money. What happens when you print money? Well, it creates more inflationary pressures. What happens when you print money? It makes the stock market go up so they can reelect the person that they want to stay in power so they can get all their handouts and their free money and all their goodies. that they've been used to getting because, the people in the White House, if you do enough favors for them, they'll do a lot of favors for you. And, they know that relationship needs to continue because Trump will put a squash on it. They don't want to have him in there and ruining their party. He wants to get rid of the swamp creatures. And they are, most of the people in politics and in business, that align themselves with the politicians are swamp creatures. That's part of the swamp he wants to get rid of. We want free market capitalism as it was intended to be, where, business is done on a fair playing field, that everybody has a chance to build a business in America, compete for the best prices, manufacture what they need to, sell what they need to based on supply and demand, and not have price fixing in the White House like they've been talking about. How can you have price fixing? As soon as you have price fixing, you squash supply. Nobody wants to supply anything. Then what happens? Oh, you get another wave of inflation because there's a limited supply. You have a supply chain mess up. So the politicians don't get what they're doing. The politicians who make policy have a big effect on inflation, whether it happens or it doesn't happen. Now, can they stop it? Well, they can reverse their stupid policies and start implementing good ones, and it will reverse it over time. One of the things that they can do to reverse it is raise interest rates to a decent level to kind of put a curb on the crazy growth. And, if you can curb, I guess, earnings, which is kind of what they do, it creates maybe less buying pressure to force inflation to be at an out of control level. The thing is, I think we're at a healthy rate now. And honestly, I think the Fed is between a rock and a hard place right now. They don't have a situation where they can win here. The only reason they've been saying they can lower interest rate, they've been lowering interest rates is in order to prop the market up so the market doesn't crash like it should. It should correct. It should go back to a normal valuation. It should. It always has, and it always probably will. And I've been saying that for a while. I still think we're, still looking forward. We're still going to have it, but because history says we always do. However, if they continue to say, oh, we're going to have this rate increase, we're going to have rate decrease, people get excited and they basically buy into the future valuations of, oh, well, with lower interest rates, companies should make more money in the future. So let's just buy up the stock market right now. Well, that makes all the politicians in power look like they're doing a great job. And if they fudge the numbers on employment and say that the employment's still strong and the job market is still strong and inflation really is getting under control because it's only growing at 2 or 3% on top of the 25 or 30 that's already grown, then it's not a big deal. And somehow we buy into that, then it makes everybody feel, enough complacency with, who's in power that maybe they don't want to change. And that's what they're hoping happens, I think, between now and the election. However, now, Fed Chairman Powell's come out and said, we really are going to change policy. We really are going to have a rate decrease. Well, what happens with a rate decrease? That's essentially, it's just like printing money. It basically makes money a little bit more fluid. If we're in a full-blown recession, I think we're not in a full-blown, very deep, hard landing type recession, but U.S., most of the middle-class people, they're having struggles. And it is a recession from the standpoint of GDP growth is not, expanding like it should. Inflation is still a problem. Supply is still, there's still some supply issues. Shoot, I couldn't even order a truck part, in less than 15 days. And it's something that was a fuel pump part for my truck, without waiting weeks for it because the supply chain is still backed up on a lot of different areas. That was just something that has happened recently. But, there's also some supply chain. I ordered a collector car, by the way, and you and I have talked about it before, but I ordered that thing 2 years ago now, and they're still waiting for the parts to get in. It's still post-pandemic parts problems with supply chain for these custom parts that have to go in that car. And I'm like, well, this is ridiculous. So what has been fixed? What has been fixed that's going to, create kind of a more of a deflationary or more of an affordable inflation level? Well, we've got to get the supply chain fixed. In other words, we've got to, create an environment where, corporations and manufacturers in America actually want to produce things because they can actually afford the products that they need to buy to produce them, that their taxes are in a level where they can, afford to be in business, where wages are at a level where they don't have to overpay for workers so that they can actually make a profit on these products, or they have to just go overseas and, wait for China or somebody else to make it. And that's a big problem. Our production, our manufacturing, even though they've been lying to us about that out of the White House, saying manufacturing's never been better, we've been stronger. Most of the sectors, there's like 11 or 12 sectors of manufacturing sectors that report on manufacturing in America, and they've almost all been down over the last year and a half or 2 years. In fact, I saw a figure that said that we're under 50% capacity of manufacturing capacity in the U.S. Why? Is that because of demand? Well, part of it is demand. Part of it is just the fact you can't afford all the parts that go into building what you used to be able to build because inflation has taken its toll. So, yeah, a president understands business policies, needs to go in and make policies that will change things, like get us energy independent, because that's really where it all starts. Energy is a big deal. Taxes are a big deal. Free market, not restricting things with over exhausting government interference and restrictions that are way overdone. And that's, kind of the present White House is, they want to get their hands in and control everything, but all it does is cost everything more money. So, I think a president that wants to get government hands off of free market systems, which is the President, Trump's methodology, would be better to get inflation taken care of and get our economy back in check. Obviously, the other party has basically killed it. So, yeah, to answer your question, policymakers in Washington definitely have an effect on inflation, and they can not only get us into it, which they usually do, but they can get us out of it if they do it smart.
Talking with Jeff Olgan of Premier Retirement Planning and Wealth Management here in Tucson and also up in Mesa. And we're talking about the president affecting the inflation rate. Jeff, you did talk about interest rate cuts, and I understand here in September that we're expecting an interest rate cut, 25 basis points, possibly 50. Do you see more rate cuts coming later on in the year?
Yeah, I do actually. I think the fact that the recession factors are finally coming to play, that, the employment situation isn't as strong as they thought it was. GDP is not growing like they thought it was. They might finally admit that maybe we are kind of in a recession. We typically, the Fed typically will lower interest rates during a recession or to stimulate the economy. But, right now we know that most of that economic stimulus ends up being money that goes into the stock market. So the market might actually do okay. But here's the catch-22 of all that is the market's already priced in, since October of last year, priced in like 7 rate cuts. And then every time there's going to be another rate cut, they price in another rate cut on top of the ones they've already priced in. In other words, they're already paying so much for a share of stock based on the fact that they're supposedly going to earn so much more once they lower interest rates. But by the way, 0.25% interest rate drop from a 5.25% Fed funds rate is nothing. That doesn't do anything other than just be a talking point to get people excited about buying stocks and maybe spending some money. And it doesn't seem like the banks and the brokerage firms are doing it. The market makers are actually divesting. The CEOs are divesting. The CEOs of companies are announcing, we're going to $5 billion stock buyback program over the next a couple of years. Well, guess what's happening? They're announcing the buyback program because they'll buy stock. So investors goes, they're going to buy back stock. Shoot, that'll drive the price up. So let's buy the stock. And so it keeps the price high while the executives and the insiders sell out their stock. So it's basically self-serving manipulation from the inside. And although those records are public and people should be able to, peel that onion back and look inside and see what's going on, they don't do that. So, as far as seeing future rate cuts, the rate cuts are kind of necessary to keep the economic wheel spinning. But here's the thing. Is it creates inflation. So we're going to basically be working really hard to get inflation kind of in check. We're not in a bad enough recession because there's still enough rich people with money in stock market investments where if you lower it, you just kind of pad their pockets, and you're going to end up hurting the middle class even more, unfortunately. So, this is we've had a first wave of inflation. If you look at the past histories of like stagflation during the Carter era and other times, there's kind of a 3-wave factor where inflation happens and recessionary factors come and go. This is the first wave. We're going to see kind of some recessionary factors. I think the Fed, which typically overreacts, will probably overdo the Fed rate decreases. The market will go up, inflation will go up, and they'll say, we have to raise interest rates again because, my gosh, inflation's getting rampantly out of control again. And so then they'll either put a stop on the quantitative easing, or they'll even do quantitative tightening in order to get inflation under control again. But unfortunately, they're going to have a wrestle between how much money to print, how much money to take out, how much favors to give banks and brokerage firms, what to do with taxes, what to do with so many different things. I don't think we're out of the inflation problem yet. I think the agenda of the present party in power to continue to take on more power and more control and create a subservient society that relies so much on them that they can't ever not be elected again is really starting, unfortunately, to work too well in their favor. It's hurting, and it's hurting me to see it because I see what's happening to my kids and my grandkids and what they're looking forward to. And I'm not really thrilled about it. Thankfully, there is enough wealth, and hopefully, families will take care of each other and we'll get back on track. And if this inflation thing kind of just blows out of control and the next 2 waves come in the next few years, and it might be on Trump's watch, and he might end up being blamed for it because of all the problems that, need to be fixed. But there's usually a little bit more pain before it feels better. It's kind of like ripping off the Band-Aid. It might be a little bit painful, as we go through the healing process. But again, like all bad times, we emerge better. If we stay on this trajectory we're on now, it doesn't look good. The fact is we're going to have to go through some waves of corrections and maybe some a little bit of pain before it gets all the way better. But just like we came out of the Carter eras of stagflation and grew again for the next few decades, I have high hopes that we'll get through this next few years okay and be back on our feet again.
Before we continue, Jeff, I want to talk to our listeners. If Jeff's comments resonate with you, you'd like to get in and sit down and talk to him about your journey towards a confident retirement. Again, we're offering this no-cost, no-obligation retirement blueprint at Premier Retirement. To get yours, call 520-780-9059. You can make that call this weekend. Leave your name, your telephone number, and Shelley will call you back during the week and set up that appointment for you. Once again, it's a no-cost, no-obligation consultation. We call it the Premier Retirement Roadmap. Again, no cost, no obligation. 520-780-9059 is our telephone number. Make that call this weekend. This one call could make all the difference. Jeff, time for a break. When we come back, we've got listener questions and more when Premier Retirement continues here on 790 KNST, Tucson's most stimulating talk.
You can't start a trip you've never taken without a plan, and you can't start your retirement journey without a comprehensive plan to get there safely. To request your no-cost Premier Retirement Roadmap, call 580-780-9059 or request it online at premret.com. Now back to more Premier Retirement with Jeff Hogan and Jeff Shade.
We're so grateful you decided to make us part of your weekend. Of course, this is Premier Retirement with Jeff Hogan. My name's Jeff Shade. We're here for you every week for your fiscal fitness and your financial education on 790 KNST. And if you missed any part of the program today, you missed the first part, Jeff's commentary, you can hear it all over again because we're a podcast. Go to wherever you get your podcasts, search for Premier Retirement with Jeff Hogan. You'll find this show and all of our past shows so you can stay on top of your journey towards a confident retirement. And remember, if you'd like to get in and sit down and talk to Jeff, 520-780-9059 is the telephone number to do that. No cost and no obligation whatsoever. Make that call right now. Shelley, you'll take down your name and number, call you right back, and we'll set up that appointment for you sooner than later. 520-780-9059. Jeff, time for listener questions. Rob's listening to us in Tucson. Rob writes, I have $65,000 in my 401k with 95% in stocks divided between large and small cap funds. I am retired and approaching age 70. Do you recommend a different type of fund, maybe a little bit safer?
Well, I don't know what else you have, so it's always an it depends answer. That's a 401k. You might have, huge pensions that give you more money than you could possibly spend. If that's the case, then, it doesn't matter if you risk all of that 65 if you can afford to lose it. You might have $200,000 in a bank account and CDs that are, guaranteeing you 5%. Maybe you have enough safe money, but if that's all the money you have and you have just income coming paying your bills, I'd be a little bit worried about $65,000 in large and small cap funds. I'd, consider putting most of it, maybe 50 of it, in something that's more like a 5% interest in short-term bonds that are, fairly liquid that you might need for a rainy day. You also might want to consider, depending on your tax bracket, that's not a whole lot of money to convert maybe this year and next year into a Roth IRA that you can take money out of tax-free, and not have those RMDs, required minimum distributions, start up for you in a few years. So there's a few different strategies I would look at, maybe in addition to just, where do I want to allocate my 401k? Obviously, when you do comprehensive planning as a fiduciary like we do, we have to take the whole picture into consideration. If you're just coming to me and say, hey, I've got $65,000, you want to invest it, shoot, I'll throw darts at all kinds of speculative stocks and see if we can triple your money in a few years. But you might lose a bunch of it too. Do you want to do that? Well, most of my clients don't. Most of my clients are, people that do business at Premier want to retain their wealth and not necessarily speculate. However, if you've got an account that you want to speculate, we can do that. Again, just depending on what your long-term and short-term goals and your what realistic needs are for that $65,000. If it's your only fund that you have that's going to support you in an assisted living facility or nursing home in a few years, maybe you do the Roth conversion so you don't have to take those required minimum distributions. You can grow it as big as you can, or keep it as a 401k, reinvest the withdrawals into something that you can grow, some other investments for your future if that happens to be your last final expense type money. So again, I don't know enough of the bigger picture. If that's everything you have, I'd take a lot more conservative approach because I don't think you can afford to lose any of it. If you have other money, then I don't necessarily have a problem or not have a problem with the mix that you're playing right now.
Rob, thanks for listening to us in Tucson. And of course, we'll send you out Jeff's book, Retirement, The Road Ahead. Jeff, next question here is Sheila in Catalina Foothills, and Sheila writes, my husband and I are in our mid-70s and early 80s and have been slowly converting traditional IRA money into our Roth IRAs, avoiding IRMA penalties. Do you have a suggestion as to where to invest an unexpected $100,000 inheritance? I would consider this extra money that may not be drawn on for several years and would like it to be under our living trust. We'd also like to minimize any income tax implications. Please advise.
Well, there's a couple of things. If you want just, if this is just money that you want to leave as a legacy and just not pay taxes on it till you die and not have, anybody else pay taxes on it. Maybe if the younger of you in the mid 70s is healthy, you could even do a single premium life insurance. We'll call the MEC, a modified endowment contract. I've got several clients that are growing their money by 5 to 7% tax free. And, the death benefit, which is more than that growth, would go to the heirs when they pass away, and it would never affect them tax wise. The other thing is you can always withdraw the money, out of the account as you need it and use it should you want it. You can do that with annuities as well if you don't qualify as far as health wise for what I'd say the single premium life or a modified endowment contract, where it's really like your tax-free bank account that you just park and leave for your kids or heirs, or you can park it and leave it for your own long-term care or critical care in your final years as final expense plan as well, and it wouldn't affect you tax-wise as well. Or you can do an annuity where you can defer the taxes and just pull out money when you need it and not let it affect your taxes. Especially what I see that is if you were to invest that $100,000 in, let's say, a mutual fund, and every year you get billed whatever the gains are in that mutual fund. Let's say it goes up 20% next year. You have to pay tax on $20,000. You don't find out how much of that was actual gains until after you've done your Roth conversions next year. And then you find out that extra $20,000 got you kicked into a higher tax bracket. Now you're paying 30% or so, on taxes on that money, or that you end up doubling your IRMA on your Medicare premiums because you didn't know what your investments were going to be. So I especially if you're doing the Roth conversions for the next few years, trying to get out of that IRA required minimum distribution program, not go into a higher income bracket to where you have to pay those IRMA penalties or even a higher tax rate, then you probably have to look at tax deferred or tax free type opportunities with that $100,000 inheritance. So keep in mind, some people say, oh, well, I can just put it in municipal bonds. Keep in mind, municipal bond interest may not be taxable, but it does count as provisional income, which is taken into consideration on how much taxes you pay on your Social Security, how much taxes you pay on other income, and whether or not you pay an IRMA penalty. So keep that in mind. Tax-free municipal bonds are not really tax-free if they affect other areas of income to make other parts of your income taxable or penalized on Medicare premiums, et cetera. So be careful of the overall picture. I would look probably at if it's long-term money and you don't want to take a lot of risk, but you want tax benefits, you could just park it in an ETF, exchange traded fund, and let the market roller coaster ride it till the end. Or you can do something a little bit more safe, where you can do an index annuity where the market goes up, you make money. Where the market goes down, you don't lose money. It's tax deferred until you pull the money out. If you die with it, whoever gets the money gets to pay the taxes on the growth, not you. So again, those are some ideas that you might want to look at. Again, depending on your risk tolerance, just where you're at with other assets. I don't know how much those IRAs and Roth IRAs make up of your necessary income planning, whether you've got pensions and Social Security that pay all your bills, whether you'd like to have a little bit more for fund money, whether you're being too conservative, maybe you're overspending. We got to look at the whole picture before I would give you a final answer. But I hope that was enough food for thought to get you thinking about the right things. My job isn't always to give you answers. I want to help you ask the right questions. In fact, that's what our whole premise of the book that I wrote that many of you who call in and with these questions are going to receive. But it's really about, do I know what questions to ask so I can get better answers? And most of our callers or people that are writing in these questions have great questions. Right. But without the context of the overall picture, you really can't give the answers, but I can give you more questions to ask so that you can get to that right answer in the context of a complete, comprehensive plan.
Sheila, thanks for listening to us in the Catalina Foothills. And again, for a more detailed answer, call us at 520-780-9059 so we can sit down with you on an individual basis, get all the information that we need to guide you where you want to be. 520-780-9059. And as Jeff said, we'll send you out his book, Retirement: The Road Ahead. Jeff, question number 3 here. David, listening to us in Reedy Ranch. David writes, I love seeing you on late night TV. Quick question. I have about $100,000 that I want to put into a CD for about a year and see many options for online banks with good rates. Sallie Mae, BMO, Alto, etc. Are they reputable, and are these online banks safe? Any concerns or questions that I should ask? Thanks so much.
Well, I think, the names that you named, you've got Ally Bank, Capital One, you've got a lot of banks that do a lot of online marketing. Frankly, when they're not building brick or mortar buildings and staffing it with tons of agents, they can actually afford to pay more on, in interest to a client, because online is a cheaper way to market, a cheaper way to run a business. So I find a lot of my clients that do have bank money that they want to keep as bank money for, short-term and relatively short-term investment or savings needs, use the online accounts and have had no problem. I don't believe that you're going to have a problem, especially if you stay under that $250,000 FDIC limit. Just make sure whatever you're buying is FDIC insured. even though the FDIC doesn't have any money in it, the government will print money to bail you out of those problems, at least as according to precedent so far and what we believe that they've promised. So, FDIC insurance is good on, those accounts less than 250. If you pick an account, you want a CD for a year, go year to year, that's fine. I would also just caution you to believe just because you can make 5% or so now on a CD for a year, I don't think those rates are going to be ongoing very much longer. In fact, I don't think you can find a 5% CD that will go out 2 or 3 years. You're probably some like a 3.6 rate or something like that for 2 or 3 years is probably your maximum you'll find, because everybody knows interest rates, just due to the fact that the economy's running out of gas, you're going to have some lowering interest rates. We also see a lot of money from hedge funds, smart money, big money managers are moving assets into bonds, which effectively lowers interest rates just because the bond prices go up. And that's without any Fed intervention. So we've been seeing this happen since April, where the midterm and long-term bonds are going up in value, essentially lowering the interest rate, the effective interest rate that you're making on those bonds. So as interest rates go up, the price of bonds go down. As price of bonds go up, it kind of forces interest rates down. So we've already seen interest rates soften a little bit. And insurance companies and banks alike can only make so much on your safe money. However, an insurance company may be able to ladder that money out a little longer. So if it's just $100,000 you have, again, in the context of where's all the rest of your money, if you just want to put this in a safe place, so it's always there for either your heirs or for a rainy day in the future, you might want to consider some longer term fixed rate annuities. There are some that are still pushing 5% that'll lock in a 5-year term, and some even a 10-year term, pushing the 5 range. It used to be 6 not too long ago. So interest rates are coming down, but if you want to lock in a good interest rate for a longer period of time, still have access to some of the money, you might look at the insurance company version of the CDs. Some people are worried about insurance companies. Actually, insurance companies are stronger than banks. They're stronger than Wall Street firms. They're actually the stronger financially sound firm that you could actually park money with. I like insurance companies because of their financially soundness and their fiscal responsibility, and the fact that they don't loan out more money than they have. They actually keep a surplus and reserves intact so that they always have the money that you invest with them to give back to you should you need it, or should a claim happen and you need that money back, or if you die they can make a death claim, etc. So don't think that Wall Street risk or bank safety is the only two options that you have. There's a third world that's kind of an in-between world that gives you some competitive market related returns without taking risk, like a CD, and will probably give you some higher fixed rate returns in the meantime if you're looking at possibly going out and locking up a rate for a little bit longer term. So a couple things to consider, a few more questions to ask when you eventually meet with your advisor, whether it's us or somebody else. Hope that helps.
David, thanks for listening to us there. And Rita Ranch, and of course, you'll get Jeff's book, Retirement, The Road Ahead. And again, I highly encourage you to call us 520-780-9059. Sit down with Jeff and ask your individual questions. If you've got a question you'd like us to answer on the air, you can get it to us by going to primrat.com. Use the contact page there for use it on the air. Of course, you'll get Jeff's book, but you'll also get a good answer. And again, if you do have questions about getting to and through retirement, getting retired, staying retired, running out of money, how to pay for long-term care, really anything, we'd love to sit down and talk to you on a one-on-one basis. 520-780-9059 is the number to call. You can call that right now, as in this weekend. Leave your name, telephone number. That's all you've got to do. Shelley will call you back. She'll set up an appointment for you. Again, no cost, no obligation, no judgment, so you can sit down with Jeff and ask your questions and get your answers. 520-780-9059, or you can find out more about us online at premret.com, premret.com. Jeff, I'm going to try to get to both subjects here. I wanted to talk about long-term care, and we'll try to get to that. But before that, I'm going to talk about building an income in retirement. As you prepare to exit the workforce, you're going to need a retirement income plan that shows you where your cash flow will come from, when each income source is going to begin, and how long that income source is going to last. Sort of like a photo and a movie. A photo captures a moment in time, but a movie tells the entire story progressing through time. And just like a movie, Comprehensive Retirement Income Plan incorporates the ebb and flow of cash flows. So, Jeff, when you are building an income plan in retirement, someone comes in, they've got this bunch of money, maybe it's in a 401k, they're trying to turn that into an income plan, a cash flow. Where do we start with this?
Well, our process is really just to look at all your income sources that are guaranteed now. We consider Social Security a guaranteed income source, even though we might have some adjustments and some hiccups along the way of how they're going to fund it and how they're going to continue to guarantee it. We still consider that a guaranteed income source. maximize the strategies. We use this, maximizing software that will help us analyze the strategies available to you, as well as just, understanding Social Security in and of itself is, does it make sense to take your Social Security early so you have some cash flow and you can redeploy and reinvest and set up income streams with other money elsewhere? Does it make sense to, take your Social Security later and spend down some of your IRA monies and other things first? What's your Social Security? What is your, do you have pensions? Do you have any other situations like an annuity, maybe an annuity, a TSA or TSP, tax sheltered thrift savings plan or a tax sheltered annuity of some sort that could be turned into an income stream? And then compare those income streams with what you can get on your own by either converting some of that cash into a commercial annuity that you can purchase by yourself and maybe keep more control of your money and, find out what kind of sources of income that we can guarantee. Oh, one thing that I probably overlooked is, what are you spending now and what could you reasonably live on? What is the, I have to have at least this much money to make ends meet, and this is how much money I would like to have in order to do my fun stuff, discretionary spending, and, have a little buffer in case inflation gets out of hand, or in case I have a kid or grandkid that needs a little bump for a down payment on a car or a house or go to college or something like that, and we might want to help out. So, you've got to find out really what your lifestyle is, what your lifestyle needs are, what your wants are, what the differences of those are. And then we create an income plan. How much of that income do you want guaranteed? Is Social Security, if it's only going to guarantee a 30-year income, are you going to fly by the seat of your pants and use the extra million or a couple $1,000,000 that you have in savings from all your different sources, 401k savings and other investments? Are you going to just let the market dictate whether or not it's going to be enough to fill that gap? Let's just say for round numbers, let's say you need 100,000 net to live on, but your Social Security is providing $3,800 a month, which is about $45,000 a year. Well, where are you going to get the other $55,000 a year? Well, the stock market rule of thumb would say, well, if you have a million in IRA or savings money, the 4% rule would give you about 40 of it. Well, that still puts you a little bit shy of that $100,000 that you need to live on, that your desired income is. So, how do we bump that up? Well, what if we could put of that million, maybe we could put $600,000 or $700,000 into an annuity that would guarantee you that $55,000 of income, and then you still have $200,000 or $300,000 left that you can invest as you wish. Have that extra money to dip into for those emergency purposes. If you don't have to touch it, you could leave it at and kind of let it go up and down with the market if it's not that big of a deal. Maybe you put half the money in a safe place. Maybe you put half of it in something that, gives you some, growth potential of doubling or tripling your money in the next 10 or 20 years so that you can have, a nice little nest egg for extra money in the future. Keep in mind, though, that, Social Security is going to give you an automatically, cost of living adjustment, at least as far as we know it will. Some of these annuity products, the way you get fixed income, don't necessarily go up with income. So you have to take that into consideration. Are you going to want to build in, an inflation factor to where you want to have the same amount of today's dollars spent every year, even in spite of inflation? Well, I will tell you, in my history, I've noticed that people don't spend as much in their 70s or 80s as they spend in their 60s. They don't spend as much in their 80s and 90s as they spend in their 70s, and so forth. You actually spend less money as you get older, even with inflation, because you just don't do as many things. You don't have so many discretionary expenses. You don't buy cars as often. You don't go see the grandkids anymore. They're coming to see you, and different things that, you used to spend money on because you're in those go-go years. You don't spend money on later in life. So, many clients really want to spend less now so they make sure that they have a big buffer later. Other clients say, you know what, I know I'm going to spend more in the next first 10 years or so of my retirement. Let's front end load it so we can spend a little bit more now. How does that work? Well, we put a plan together that encompasses 3 decades in many cases or more of your future retirement years. And we use very conservative estimates on returns on investments. We put in, what's guaranteed, what's speculative, what's not guaranteed, and create a plan where we can get a reasonable assumption of this is a reasonable expectation of income where I won't run out of money. Is this enough to cover my needs? If it isn't, then maybe you need to change your needs a little bit. Downsize at least the vacation home or something, in order to maybe curb some of the expenses that you have or increase some assets that you can reinvest for income purposes. So we might have to make some, unfortunately, uncomfortable changes on the downside. But most often, I find that people come in thinking they can live on a lot less than they really can if they would just take a chunk of their money, guarantee it with income sources that are guaranteed for life, like the commercial annuities that are available now that are set up for retirement income are better, in my opinion, than most people's pensions. Most people's pensions, once you lock in that, let's say you have $500,000 at a company for a pension and they're going to give you $24,000 a year forever, but you die 10 years down the road, you only got half your money back. Well, what if you could get, instead of $24,000 a year forever, you can get $22,000 forever, but you always have the balance of your account available to you. And if that account grows, you get a raise on your income. So it might go up to $25,000 or $30,000 or $40,000 if that particular portfolio actually performs. And if it doesn't, hey, it's on the company that offers it. They're still going to guarantee you what you started with. So there are a lot more ways to look at all these different income sources, but we have to consider what's available to you, what your goals are, what your life expectancy is, what your lifestyle is, what your and some of these are just going to be assumptions. Some of these are going to be based on knowledge that you know what you spend, you know what you like to spend, you know what your lifestyle requires. And if you saved well and you've lived responsibly, I'm sure you're going to have enough buffer that's going to surprise you that you can spend more than you think. If you haven't, if you've overspent and now you've got to, the chicken's going to come home to roost someday, and you're going to say, oh man, I should have saved some more. Well, at least I enjoyed the first 30 years. I'm going to have to, tighten the belt a little bit and eke it out. Or I'm going to have to find a consulting gig or some sort of a side hustle during my retirement years to make up that difference, which a lot of people do. And that's not a problem. I don't have a problem. I'm not going to say one person's more responsible or has a better plan than the other. Some of my most happy clients that I have ever met are the people that are poorest in retirement, but had so much fun during their income years that they don't care. I'm not going to put that on you. And I've had some people that are misers. They've been such misers during their working years because they wanted to save millions and millions for retirement. And now because they've never gotten used to spend it or they felt too guilty about spending it, they never spend it in retirement. And so they end up dying rich and never being happy. So you got to find that balance to where, your money serves you, you don't serve your money, and you don't take it so seriously that you don't have any fun and enjoy life. So there has to be that balance. And that's part of the Premier Retirement Plan. The roadmap is to, create a sense of comfort or expectations or a sense of confidence that you can spend without worry because you have enough income sources that are guaranteed that at least all your bills are going to be paid, and you're not worrying day to day whether you get up, whether you're going to be able to still have money in 10 years or not. We make that plan now so that you can see that you will, and as long as you don't get crazy or don't deviate from the plan too much, typically you'll find that you're in good shape.
We're talking about creating an income plan with Jeff Oken of Premier Retirement Planning and Wealth Management here in Tucson and Mesa. Jeff, once we've created this income plan, now I'm retired. I'm used to being paid bi-weekly, maybe once a month. Do I have a choice as to how frequently I get paid, and how do I get paid?
Well, depending on the product, we have some, I've talked a lot about, annuities that pay guaranteed income. Typically, people would just take a monthly income from those. Some people might want to take just an annual income, stick it in savings, just live off it and, spend a little bit different amount every year, just depending on, what your lifestyle requires or what your comfort zone is, what your set of values would dictate is right for you. There is no right or wrong answer, but those options are typically available with different products and different companies. Some companies only offer a monthly payout if you want to take an income. Some companies offer you all kinds of choices, monthly, quarterly, semi-annual, annually, or just whenever you want it. There's also, the tax-free income stream that I really like is the LIRP, Life Insurance Retirement Plan. And that's one thing I probably didn't mention in the last answer as far as how we develop an income plan. We also find out, where you're going to be tax-wise and if you need some tax-free income. And if we do, we move some of that money that would otherwise be in your own personal pension plan into a tax-free pension plan, which we do through a life insurance policy, because a life insurance policy is tax-free. The money you put into it grows tax-free. When you die, it pays out tax-free. And the cool thing is that money that you put in it grows and compounds tax-free minus the cost of insurance, which doesn't have to be a lot. It could be, you don't have to buy a ton of insurance to play this insurance game, but for about the same price as you would pay as a fund fee for a mutual fund, and probably less than you would pay me as an advisor, any advisor that charges 1% or more for fees, you could pay less than that just for the cost of insurance in order to play a tax-free pension game for yourself. And what you're essentially doing is you get to borrow against your account that's growing at, let's say 5 to 7% is a typical range of growth. You get to borrow money from that account, and that money that grows is buying you, multiple times of what you put in it, a death benefit. You're actually borrowing against your death benefit. You borrow your death benefit, you live on it while you're alive, true life insurance, but when you die, the tax-free death benefit pays off all the money that you lived on when you were alive. So, there's a sweet way to create some tax-free income through retirement, as well as just hey, how much income can I use? So you could get paid based on loans from a LIRP, fixed income from an annuity that you created for lifetime income. You could have a withdrawal that you just took a certain amount of money off of your stock and bond account. Depending on how it's doing, you kind of use that as your discretionary. Hey, we can go on a nice trip because the market's doing well and the interest rates are paying high interest. Or hey, things are a little bit tight. We got to tone down the discretionary expenses because our discretionary account isn't performing quite so well this year or next or from time to time. So again, depending on how you structure it, how much do you want at risk, how much you want to pay taxes on as you go, how much income do you need, how much extra income do you want, and what can be my discretionary income, and by the way, how much tax-free income do I need so I don't get kicked into a new tax bracket that I won't like during retirement. I mean, you save all your life and then you have to give, somewhere between a quarter and a third of your money to the government while you're retired. I mean, that's just, I don't know. It's just like a kick in the gut. So if you can minimize that, keep it down to the 10 to 12 or 15% range, it's a little more palatable, even though, I know we all have to pay a little bit of our share, but you don't have to overpay in taxes. If you plan right, you can pay the minimum amount that you have to pay and no more than that, and keep what's rightfully yours, spend what's rightfully yours, keep it in your family, keep it in your community, and make the world a better place by not sending it to the government.
Jeff, our listeners have questions about creating an income plan. Of course, our number, 520-780-9059. I encourage you to call it this weekend. Set up your appointment to sit down with Jeff and ask your individual questions. Get the answers that you need to put yourself on the path towards a confident retirement. No cost, no obligation, no judgment. 520-780-9059. You can also find out more about us online at premret.com, PREMRET.com. Jeff, we're out of time for this week. I'm going to thank you for your time, but most importantly, as always, thanks to our listeners here for joining us. For Jeff Ogan, I'm Jeff Shade. Have a great weekend. We'll talk again next week with another edition of Premier Retirement right here on 790 KNST, Tucson's most stimulating talk.
Investment advisory services provided through Premier Wealth Advisors, LLC, an Arizona state-registered investment advisor. Securities transactions are placed through TD Ameritrade. Insurance and annuity products are offered through Premier Advantage, Inc., DBA Premier Retirement Planning and Wealth Management. Investing involves risk, including the potential loss of principal. Any reference to protection, safety, or lifetime income generally refer to fixed insurance products. Insurance guarantees are backed by the financial strength and claims paying abilities of the insurance carrier. The show is intended for informational purposes only and is not to be construed as advice or recommendations. Due to show format, accuracy, and completeness cannot be guaranteed. Premier Retirement and its representatives do not provide legal or tax advice and may only conduct business with residents of states and jurisdictions where they're properly registered.